Of course, Japan very much in focus. Let's take a look at the Japanese yen. A lot of strength going into that currency today, especially after the DPJ victory. Currently, dollar-yen sitting at 92.64. And also take a look at euro-yen as well at 132.47. Well, the yen hitting a 7-week high versus the dollar after the Democratic Party's historic win. And plenty of data out of Japan this morning as well. Industrial output rising for a fifth straight month, up 1.9% in July thanks to a recovery in exports. The pace is expected to speed up in the coming months as well. Manufacturing activity also gaining momentum as well. The Purchasing Managers Index, the PMI, up a seasonally adjusted 53.6 in August, and that is the highest level since November 2006. Retail sales, in the meantime, taking a smaller than expected drop in July, down 2.5% instead of the 3.6% level that analysts were projecting. We need to shed more light on what is happening to the Japanese economy and also the markets there with Darius Kowalczyk, Chief Investment Strategist at SJS Markets, joining us live from Hong Kong. And of course, we have our Tokyo Bureau Chief Kaori Njoji, who will be taking part in the interview as well. Thank you very much, both, and hope you had a wonderful weekend. So, Darius, it seems like based on the notes that you've sent us, you're quite bullish on Japan, and you have upgraded the GDP forecast as a result of the election. Tell us more.
Indeed, I expect that next calendar year, the Japanese economy will expand by 3.4% and the following year by 2.1%, based on a recovery of exports and capital investments. But now that we have a new government in sight that is planning to stimulate the economy through domestic consumption, we have added 0.2% to next year's growth forecast and 0.4% to the following years, based on the assumption that the Japanese consumer will be optimistic ahead of the policy change, and the changes itself, such as child allowances and so forth, in the longer term will stimulate positive demographic trends and overall GDP growth.
Well, if you are upgrading Japan's GDP forecast because you are projecting a recovery in exports, but take a look at what is happening to the markets today. We're seeing a strength in the Japanese yen, and that has actually helped reverse the earlier gains that we saw.
Exactly. That's a very telling sign that the yen has the capability to kill the equity market recovery and possibly the economic recovery as well. And that's why I believe that the new government, in collaboration with the Bank of Japan, will have to do something with the currency's strength. Otherwise, Japan will price itself out of a lot of its important markets. And I think that Bank of Japan will have to intervene somewhat because it doesn't seem that the market is going to drive the yen weaker. So in the short run, I think that the yen does not have much upside. The exchange rate will not fall much below current levels because the market may fear intervention. And if market doesn't fear it, the Bank of Japan will have to do something. So by the end of the year, we forecast that the yen will be trading at 100 against the US dollar.
Darius, it's Kaori in Tokyo. Time and time again, Japan has been pressed by its trading partners to stimulate domestic demand rather than rely on exports. And time again, they failed in their attempt to shift the balance of the economy here. What gives you the confidence to suggest that things may be different this time around?
Well, the key reason why Japan has been unsuccessful so far is the negative demographic trends. You cannot stimulate the domestic demand if your population is shrinking and getting older. The only hope for a longer-term upward adjustment in Japanese growth potential and for domestic demand to take over that growth would be a shift in demographic trends. And finally, we are dealing with a government that is putting a lot of emphasis on that, planning to spend almost $60 billion in child allowances, an amount that may actually work. And if it does, this will be a paradigm shift for Japan if we really manage to reverse those negative demographic trends. If that government doesn't do it, there is no hope. So I think there is a good chance that they will.
Darius, getting back to your earlier thought that the authorities may intervene to put a floor under dollar-yen, without that, though, could we see a situation where we see runaway yen strength, especially with interest rates headed higher in the face of more debt issuance?
In the short run, without some government intervention, indeed there is a high likelihood that the yen would continue to strengthen. On one hand, investors will be more upbeat about Japanese growth outlook under the new government, and this might attract capital inflows. Furthermore, if domestic demand is indeed stimulated, and you mentioned those higher yields, then Bank of Japan also may have to increase interest rates faster than they would otherwise do. So all of this would be yen positive in the short term and in the medium term. In the long term, not necessarily, because if indeed we have focus on growth driven by domestic demand and not exports, then in the longer run, current account surpluses might decline. But in the short term, without government action, definitely the yen
Darius,
would come under upward pressure.
We're running out of time. I wanted to slip this question in. If the DPJ's policy is all for bumping up domestic demand, could this mean that a lot of investors should start rejigging their portfolio to move in on some of those domestic-oriented companies? How much more upside do you see?
I believe that it would be prudent to somewhat reallocate portfolio weightings within the Japanese equity universe towards those companies geared towards domestic demand. But I wouldn't do it very aggressively until I see details on DPJ policies.
Okay, well, thank you very much. I'll appreciate your thoughts and time, as always. Darius
Thanks for having
Kowalczyk
me.
from SJS Markets, thank you very much. And of